get started. So thank you everyone for joining us for our Cash Plus webinar today. We're very happy to have with us Nick Tay from Lion Global. So as you know, the underlying funds for Cash Plus are Lion Global funds. And yeah, we just jump into a quick intro. So today we're with Ritesh. I think most of you probably already know him. He heads up our advisory team at Syfe, and before that, he was with Goldman Sachs and Morgan Stanley. And yeah, I think most of you might have seen me too. So I'm responsible for research efforts at Syfe. And before this, I was in fixed income for the last 8 years. And of course, Nick, our guest speaker. So he's a director at Lion Global Investors, and he's been in the industry since 2008. All right, so now it's the agenda. We'll have a very quick intro of Syfe, and then Nick will go over some comments about the overall macro environment, and then we'll go into some, just a lot of frequently asked questions that we get, right? So what's the Fed funds rate? How does this interest rate that's decided by the Fed affect the holdings of, bonds in Singapore, right? And that's in Cash Plus, and also what's the way forward? And then how does our offering stack up to the alternatives? And then, of course, welcome any audience Q&A. So if you have that, you don't have to wait till the end of the session. The Q&A portion, please feel free to put your questions in when they come up as we're going through the slides, and we want to address everything. All right, so over to you, Ritesh. Oh, sorry, you have a poll first. So if Vivian, if you could pull up the poll. Okay, so there are two questions to this, and the first is how much cash do you hold in terms of months of salary? So less than 3 months, 3 to 6, 6 to 12, and then more than 12 months. And the second one is how long are you thinking of parking your assets in Cash Plus or in any cash investment solution? So again, it's less than 6 months, 6 to 12, 1 to 2, and then more than 2. Okay, so generally I would say 3 to 12 months. It's the most popular. So I guess that's relatively in line with the advice, right? How you should have at least 6 months of salary, kind of being quite liquid. And then the next one, this is interesting because I think when we did this webinar earlier in the year, right? I think the sort of longer dated stuff, the responses were fewer there. So yeah, thank you, everyone.
Hey Grace, thanks for covering that, and very interesting results from the poll as well, to kind of understand where people are with respect to their cash and how long do they want to deploy money in cash-oriented solutions, right? All right, I think most of the people who have joined in today, you might already be our clients, but just being conscious that there are new people who constantly join our platform. So I would like to quickly introduce Syfe. So Syfe is a digital investment platform. We are headquartered in Singapore, and we are building the next generation of investment solutions for individuals across Asia. In terms of our platform, we are a one-stop platform for all your investment needs. So whether it is fully managed portfolios for long-term wealth building, or our digital brokerage platform that we launched early in the year to get fractional trading access to US stocks and ETFs. 2002 has been a pretty big year for us. We have gotten multiple awards, as you can see in this particular chart. More recently, being voted as the top 15 startups in as part of the LinkedIn survey. So these have been recognitions in terms of what we are, what we've been building, and the fact that we are able to cater to a wider audience of users, whether it is with respect to their passively held investments or customized solutions, or when they want to express themselves and invest directly into individual stocks and securities as well, right? So trying to cover the entire ambit of investment needs for our clients. In terms of our journey so far, so obviously we have now been in the business for more than 3 years. We are backed by strategic investors as well. We have grown strength from strength, and mostly led through innovation in terms of the products that we bring across for our users. This particular year, we have gone outside of Singapore as well. So first time foraying in the Asia Pacific region into Hong Kong and Australia. And we just celebrated 3 years of our anniversary in July, and also announced more than 100,000 clients in Singapore who trust our platform. So some very key milestones that we have been able to achieve over the course of our journey. But again, I think we've just gotten started. We will continue to build more products and solutions for our investors as we move forward too. In terms of, if we move on to the next slide, it kind of gives you a glimpse of what is our current suite of products on the platform. So on one side, there is the wealth platform, which has more of the managed solutions. So we have, pretty much 3 buckets. So you have the core portfolios that cater to your long-term wealth building and long-term goals. These are globally diversified across asset classes, geographies, and sectors. There are choices available depending on your investment time horizon and risk appetite. You can choose between a defensive portfolio, balanced growth, or equity 100. Equity 100 is, one of our more popular portfolios for more growth-oriented investors who want 100% exposure to the equity markets. Then we have what we call as satellite portfolios. These portfolios are supposed to complement your core portfolios and help in additional diversification. Because if you think about it, like this year particularly, the correlation between equity and bonds have been broken, meaning that even a balanced or growth or defensive portfolios have had similar drawdowns compared to an equity-only portfolio, right? So in this context, asset classes such as REITs and other such instruments have played a pretty good role in terms of diversifying your exposure and also fighting through this inflationary period and all. So REITs is one of our key product differentiators. It is built in partnership with Singapore Stock Exchange. It gives a dividend yield of more than 5.5%. And again, I think people looking for generating higher yield on their Singapore dollar cash is potentially a great one to help in addressing part of that need. We also have thematic portfolios which kind of cater to the longer term mega trends. These are obviously more risky in nature as well. So our guidance is always to use the core portfolios as your starting point where bulk of your money should be, and then dabble into these themes because while they can give you very high returns, they are very high drawdowns associated with them as well. In terms of taking it a step further, we have introduced custom portfolios, which gives you the control in terms of defining your own portfolio, your own strategy. So this is one of its kind, industry first in this part of the world, really helping clients to personalize their portfolios to their needs. We have recently added an edit feature, so people who create their custom portfolios, you will be able to edit your portfolios on an ongoing basis as well. And of course, we'll talk more about Cash Plus today, so that's what the session is all about. And apart from that, we have the trade platform, which then gives you access to single securities where you want to take direct exposures to the underlying stocks, ETFs that you love. All right, so we have 2 questions. So I guess the first one is, what are your key concerns right now? Obviously, there are a lot of events happening around the world, and stock markets are materially down, more than 20-30% down. So concerns about interest rate, recessionary risk, inflation, geopolitical tensions. And to that extent, people are looking for safe haven assets, right? And from a safe haven standpoint, cash and cash management solutions could be a place where you can temporarily park your money. But I guess the question is, what kind of cash management solution or cash-like solution are you looking for? Do you care about stability of returns, or do you care about higher kind of projected returns of these instruments? So projected yield of 2.3 with no negative weeks of return, or a projected return of 3.5%, so much higher, but potentially there could be a few months where you have negative returns, right? Or drawdown in the value, it can drop by 2%, 3% kind of a thing. And then the third, FDs, because now FD rates have increased as well. Some are giving in maybe 2.5%, but then you lock in your money. All right, interesting. So looks like, all of these are concerns, right? Everyone is concerned about all of these factors. But I think the interesting part is about the second question, where a lot of you do favor the more stable kind of cash management solution, because when you are parking your money in a cash-oriented solution, you would not want that to also have drawdown, especially when the bigger markets are going down. But I mean, still conscious that there is a decent percentage of you who also are okay with a higher yielding product. And maybe you are investing for the next 1 year. So you don't mind a potential, couple of months.
But first of all, thank you so much for inviting me back. It's always a pleasure to be talking to you guys, and I guess I must have done something right to be invited back for an encore performance. But I recall the last time
Not
that
just encore, I'm sure we'll have you back again.
And as long as you welcome me, I'm happy to do my part and have a little bit of a chat about where the rates and yields are going. But the last time we chatted, I remember that we did make a little bit of a recommendation, is that to hold a little bit in cash because the markets are uncertain. That turned out to be correct move. Since then, markets have always just gone one direction, down. And the other thing that we did talk about was maybe consider a little bit of S-REITs. Not go whole hog into S-REITs, but certainly the S-REITs as an asset class has been relatively resilient compared to the rest of the Asia Pacific equity complex, which by my last count, I think we've now seen 17 consecutive months of declines. So it's volatile times for sure, and so definitely in a market like this, where a product like Syfe Cash would be something, Cash Plus, would be something that is very much valued. And I think we have to take a little bit of a look at broad macro. Fact of the matter is, we watch the market compulsively, especially in a time like this, when a lot can be compressed into a very, very short span of time. Overall, what we're looking at for rates, the Fed has put out very strong language. They'll hike until quote unquote something breaks. Whether that thing that breaks is inflation or the economy, we have yet to see. But one of the things that we do know, inflation, forward-looking PMI indicators, these are forward economic indicators that give us a sense of how the global economy is going. They are all generally down, right? The expectation is that inflation is going to come down. This has also been helped by weak commodity prices that came about with the oil price volatility. So right now, going to the fourth quarter of 2022, there is a bit of a tug of war. On one hand, you have the Fed that continues to hike because, for better or worse, Jerome Powell could take up the name Jerome Walker because he is taking a page out of the previous one of the previous Fed chairman's books and hiking rates in an effort to make sure that inflation doesn't go out of control. Now, with all the economic data, if it continues to stay strong, then it's likely he's going to continue to hike. And the market generally is pricing in another 75 basis point hike in November and perhaps another 50 basis points in December. That will bring the year-end Fed funds rate to between 4% to 4.25% to 4.5%. Now, what that generally means is that between now and the end of the year, if inflation doesn't start coming down, then the Fed will continue to hike. If the Fed continues to hike, that will likely cause the economy to weaken further. And right now, I think what we're seeing is we are coming close to a point where we've seen a little bit of a spike up in the 10-year Treasury yields. So this is a chart at the bottom here. I will highlight the highest point that we've seen since 2018. Now it peaked out at 4%. And given everything that I've just said about the weaker economic data coming out, this seems to be what we expect to be a bit of the top of the 10-year Treasury yields. Now, how all this really impacts the economy is really the world is looking to get a sense for when exactly will the Fed start to ease off their hiking rates. So the chart on top illustrates that all these lines are basically expectations of where the Fed funds rate is going to be, and whether or not, regardless of economic data currently, whether you take what is the Jeffries outlook, as well as what is the Fed dot plot saying, as what is the implied forward rates telling us, the world expects that a pivot is probably likely to come sometime in the second or third quarter of 2023. right? So assuming that the Fed continues on its current trajectory, we do see the Fed funds rate peaking out, or the market does see the Fed funds rate peaking out sometime then. Prices have already reacted to the Fed hiking rates. Now, bond yields have moved up. Bond prices have also discounted that. So that, in a nutshell, is where we see the rates and the yields at this point in time. Right. So I'll pause here for a second. So hopefully happy to take any questions that may arise at this point in time. Maybe I hand the time back over to Grace.
So I think one question is sort of like a back to basics question, right? What is the Fed funds rate? And how does it really affect yields of bonds, right, that are held in like a product like Cash Plus, given that they're not, in the US, not USD denominated. So if you could talk a bit about that transmission mechanism, Nick.
Yep, sure, happy to. So the Fed funds rate is essentially an interest rate that is determined by the Federal Reserve. Why it is so important is because all the bonds that are in circulation take reference from what the Fed funds rate is doing. These include your mortgage rates, your car loan rates, the rate at which banks lend to one another, the rate at which individuals can borrow from the banks. So when you take this and you take it outside of the US, a lot of your offshore bonds that are traded internationally, take reference from the US yield curve, right? And the US yield curve is essentially what the Fed is controlled by the Fed funds rate. So what happens when the Fed funds rate goes up? The basics of bonds is that when rates go up, bond prices come down. So if you use your Asian bonds as an example, you've seen your JP Morgan Asian credits, essentially Asian credit bonds. They've come down in price year to date. I think they've declined something in the range of 10 to 15%, depending on the credit rating of the bonds that you're holding. So in a rising rate environment, this is why everybody is saying keep your duration short. And if you keep your duration short, this means that you are focusing on bonds that are less affected by changes in the Fed funds rate. Now, for the purpose of, I can say a little bit about a Syfe Cash solution because the underlying are both LGI components. For both of these components, you do not take the price risk. So essentially what we have done is because we keep the duration so short and we roll over the bonds so regularly, we are not actually taking price risk on any of these bonds. Once these bonds mature at par, you get the return based on the coupon that these bonds have accrued. So that is one way that you can navigate a rising interest rate environment. Consider a bond strategy which does not expose you to the price risk of bonds in a rising rate environment.
All right, so moving on. I think this is also a question that we got from the audience. So when the Fed raises the Fed funds rate, right? So we see that we've also revised the projected yield for Cash Plus. Right? But please also explain a bit about given that we have seen like 75 basis points and 75 basis points, right? But then the revision in the projected yield has not been as large.
Yeah, so this is a question that we do get quite regularly now. Looking into the underlying components, I guess it's really a question towards why have the yields of the two component funds. I can't let Syfe take all the credit on this because the underlying components do belong to LGI. We have been getting this question quite a bit. Why, put it another way, when your 15-month with UOB fixed deposit is giving a rate of like 3%, right? Why hasn't your fund invested into UOB's fixed deposit so that they can also enjoy 3% fixed deposit rates? So that comes down to the mandate of the two components. A few key things I'll point out. First is that over time, corporate bonds will typically yield higher yields than FD rates. That's just a risk premium at work. So it's a bit of a understood that if you're borrowing from a corporate, it's more risky, and as a result, you get a higher yield. The second thing is that as we are actively managing, we can't put 100% of the assets into fixed deposits. That's just not our strategy, because our strategy is to seek to optimize yield as well as to achieve a high level of liquidity as well as to preserve capital. So all those things we have to hold in balance. And the way that we do that is to have a constantly rolling over supply of corporate bonds coming to the market. And we will invest into those bonds that give us a decent level of yield, right? This also means that when the money is held in the corporate bonds in our portfolios, this money will not come out until the bonds mature. Now, when interest rates have risen to their highest levels in the past 2 decades, and they rise as sharply as they have, that means that the bonds that we had invested in, say 1 year ago, are less competitive relative to the yields that you're getting today. And as the money comes out, what we do is that we take the cash from the proceeds and we buy into these higher yielding bonds. So over time, you will see the yield of the two components continue to rise in pace with the market. Well, as for today's scenario, what we're seeing today is that the rates are rising more aggressively. Right, this is historically a very, very uncommon situation that we observe. When the rates are rising so aggressively that it's difficult for the corporate bonds that are coming into the market to digest them. In other words, your corporate issuers can't raise their rates fast enough to keep pace with the rate hikes that we are seeing as a result of Fed fund policy. Right. So that is also why we will see a case where we smoothen out the impact of rising rates, simply because not all of our investments or not all of the assets that we manage move into cash. We like to keep it as a nice gradual rising rate environment. If rates do turn and rates start coming off, this then works in our advantage, because we will then have cash invested into the higher yielding bonds, and this will help to buffer the impact of rate volatility in the market. So overall, the value add that LGI brings to a solution like Syfe is that we help smoothen out the ups and downs of the rate volatility, so that the unit holders, the end investors themselves who are holding on or invested into the Syfe Cash solution, they will not experience the volatility that comes when rates go up and rates come down. They will just get a steady, nice, safe return.
All right, so moving on to the next one, I think this is probably also for Ritesh to weigh in. Right, so why do some cash management solutions have higher projected yield but also negative performance? I think we have a very similarly phrased question, which is your yield going up with a corresponding loss of capital?
So some of these higher projected yields, the axiom in the market is higher yields mean higher risk. One of the ways that LGI has helped other investors, and I won't name names here because we do work with a whole bunch of other folks, is that we use short duration bond strategy. Now, a short duration bond strategy is fundamentally different from the enhanced liquidity fund that we run and the money market strategy that we run. And our short duration bond fund has, with all the other short duration bond funds in the market, the year to date has experienced a drawdown, right? Because there is a fundamentally different strategy. We do go out to around the 3-year mark on average, and then that means that we are exposed to price volatility. So this allocation to short duration bonds can contribute to some negative performance. I think our drawdown from peak to trough was something in the range of around high 4%. But since then, it has rebounded in the past couple of weeks. So there is an element of price volatility in certain strategies that we use. To my knowledge, I don't think Syfe uses short duration bond fund. So that's why they were not exposed to the price volatility.
Yeah, exactly. So I think I'll cover it in context of the Syfe Cash Plus solution, because I mean, all the points that Nick mentioned goes hand in hand. If you could just go back to the previous slide. Great. So what is the Syfe Cash Plus portfolio? It's a portfolio that is built using money market oriented funds. It gives a projected yield or return of up to 2.3%. So that's the current projected yield of the product. The returns accrue pretty much on an annual, daily basis, because there is daily accrual of coupon, right? So that continues to happen, and the price of the underlying funds then continue to move up as part of that. In terms of features, there are some very cool features that are built in as part of our cash management solution. You can conveniently transfer funds from the Cash Plus portfolio to other investment portfolios or vice versa, you can also get into a more systematic habit, right? Like, it removes a level of kind of friction, because when it comes to bank accounts, you have to set up standing instructions and things like that, versus you put the money into a cash plus oriented portfolio. The projected returns keep going up as rates increase. So you keep generating a decent yield. There is no lockup, there is no minimum, there is no kind of gimmicks attached. There is no management fee as well, right? So we don't charge any fees, but then you can, safely put recurring transfers into your investment portfolio to DCA into them as well. We also have some industry first features. So we have a feature of same day withdrawal, where if you want emergency funds, suppose you've put like $50,000, but you need $10,000 for an emergency need. Typically for other solutions, you will have to wait a couple of days for that money to come and hit your bank account, versus in Syfe Cash Plus, if you send in the instruction before 11 a.m., you get the money in your bank by 7 p.m., right? So that's a feature that we have built, again, being very conscious of enhancing the client experience for this. All right, if we go on to the next slide, it talks about the composition of the Cash Plus portfolio. So basically it's composed of two underlying funds. Both are Lion Global funds. And in terms of the allocation, we have a 30% allocation to the money market fund, which basically invests into very high quality, short-term money market oriented instruments. Typically, they are, two components of risks attached to any, bond oriented instrument. And we'll talk about it in the later slides. But these are supposed to be very high credit rating of A and above. And similarly, they are very low in terms of maturity. So, things which Nick was talking about, they can be valued on a, price appreciation basis. They don't, kind of see a volatility in terms of price movements when interest rates are changing, because they're typically held to maturity. And as interest rates increase, what happens is these bonds keep maturing and they keep getting deployed into higher yielding bonds that subsequently get subscribed to. Similarly, enhanced liquidity, what happens is you're still investing into very high quality debt. Maybe there are some corporate bond components that are, embedded in as well, but the credit quality remains at A minus, and the duration slightly increases, but yet really small compared to, other similar products which might have these other risks to care about. In terms of the projected return, you get a gross projected return from the underlying funds at 2.47%. Then there is a fund level fee that is charged by LGI of around 0.29, 0.3%. LGI then passes on a trailer fee to us because we are distributing their funds in a way. And because we want to be 100% transparent, we pass on 100% of these trailer fee rebates back to you as a client. And on top of that, we don't charge any management fee. So net, you get 2.3%. And an important thing that I want to cover here is the fact that, why would you go via Syfe and not buy these, underlying funds directly yourself? Because of two reasons, right? Number one, you're getting access to the institutional share class of these underlying funds. So the enhanced liquidity and the money market, you get the institutional share class. And the fee of the institutional share class, which you're seeing at 0.3%, typically, if you go onto other platforms, you will get access to the retail share class where the fees might be a bit higher, right? So you save there. The second saving is the trailer fee rebate. A lot of platforms actually do not talk about trailer fees at all. So if you're just going blindly and subscribing to the retail funds, you will typically, receive a net return, which might be, 0.3, 0.4% lower than what you're seeing here.
Sorry, if I could just interject, because we got a very similar question, and that is, why is there a difference in fee with other platforms for the same fund? I think Ritesh covered that, but again, if you were going through a different platform, right, you could be charged a platform fee as well. So in this case, right, there's no fee that's charged by Syfe for Cash Plus. And also, in terms of trailer fee, I think Nick can probably weigh in more, but generally like that, this sort of set to be standard across platforms, right? And then for us, and I think some of our competitors too, we do like 100% trailer fee rebate. Yeah, so I hope that answers the fee question. Yeah, sorry, Ritesh, please go on.
Yep, thanks, Grace. All right, so let's then cover, a little bit of what are the risk components, right? What impacts returns and what are the things that you should be caring about. Typically, when you're investing into bonds, there are two components of risk. One is the interest rate component, and the second is credit risk component. Now, these might get a little bit technical, so feel free to connect later on through our advisory team if you would like to know more. But in simple terms, when interest rates move up, the price of bonds go down, right? So they're inversely correlated. And what that means is when there is a rising interest rate environment, typically the bond prices will go down. Now, bonds which are shorter maturity, typically the prices move much lesser compared to bonds which have longer term maturity, their prices move much more. And that's mainly because, again, like these bonds are about to mature. So, even if the rates have gone up, they will typically be redeemed at the par value. So they don't get impacted that much. And plus, in terms of accounting and all as well, a lot of like platforms like LGI and others are able to value these bonds from a cost plus accrued interest basis rather than valuing them on a mark-to-market basis, right? So these are reasons why you get a very smooth kind of return profile when you're investing in very short-term oriented bonds versus if you invest into a bond which matures like, say you're investing into a bond that matures in 3 months versus a bond that matures in 2 years. The bond that matures in 2 years will be much more sensitive to interest rate movement versus the bond which matures in 3 months. Similarly, on the credit risk, it all depends on what kind of bonds are you investing into in the first place. Is it a government bond, which is basically backed by the government, so basically means that it is risk-free? Or are you investing into corporate bonds, still maybe investment grade, so the probability of it defaulting is very low, versus are you investing into high yield bonds where there is a potential aspect of the bond defaulting, right? So typically, these are the two components that impact the price and returns of a bond-oriented portfolio. Now, in terms of our own portfolio, as we shared earlier, if you go back to the slide of the composition, I think it shows that we are basically investing into money market and enhanced liquidity. The overall duration of our portfolio, I think, is roughly between 3 to 6 months. And again, these are very high quality money market oriented instruments or high quality corporate bonds. So typically they are held to maturity. And because, they are categorized as money market and, similar segments, we are able to value them on a cost plus accrued interest basis. So that means that when you invest into our cash management solution, you get a very smooth return profile. And when interest rates increase, it also jumps in value, because at any given point of time, and Nick can weigh in here as well, typically 20 to 30% of the portfolio is always ready for kind of redeploying, right? So as the rates increase, you will see that with a 2 to 3 week lag, the interest rates sort of pick up for our cash solution as well.
Yeah, so definitely we've gotten a similar question. Let me just add on a sentence or two to that. We do keep around 20% of the both money market and enhanced liquidity fund in cash equivalents. And where does that cash come from? It comes from maturing bond proceeds. It comes from subscriptions and net of redemptions. So essentially what happens is that at any point in time, we in theory, we only have 20% to buy into new bonds to increase the yield. Now that will make a difference, but we can't deploy all 20% of it, right? We are very prudent when it comes to liquidity management to make sure at all times we can make good the redemptions, especially in a volatile time like this. Markets have been coming down consecutively for more than 12 months already. We have seen subscriptions and redemptions at higher elevated levels than a typical well-behaved market. So for that reason, we're maintaining a good amount of cash buffer. That also means that the increase in the yield of both these portfolios will be gradual, right? So like I said, what we give is a nice, steady, upward appreciating yield to maturity. We don't want the risk of running out of cash or the risk of having to break bonds when things are volatile. So for that reason, for the purpose of managing or being prudent stewards of assets, that's the strategy and the approach that we have taken.
So I think this one is a very important slide because it really talks about what different cash management solution components are and how do you kind of discern between these different solutions that are now available in market, right? There are plenty of these cash management solutions available in market. Some with project very high kind of projected yields, but again, there is a risk involved, right? There is no free lunch. That's very important to remember. And typically, if you see from a risk standpoint, as I covered earlier, money market and enhanced liquidity, which is the ultra short duration components, are the much lower or the lowest risk components. As soon as you get into short duration or even longer, the risk increases in terms of your interest rate sensitivity, as well as you take on more credit risk in those components too. So typically what that means is, in terms of projecting a return, the money market and enhanced liquidity will obviously have a much lower projected return, but they will be much, much safer. They'll be much more stable in terms of their return profile, versus if you have short duration and other longer duration components, then you will see volatility within your cash solution as well. And that's, I think, very important, because you really need to ask yourself that question: what is this cash meant for? If it is meant for a house down payment, which is 3 months away or 6 months away, investing in a solution which has short duration components and all can be risky, because you can actually lose money. And we covered this earlier. Some of these cash management solutions have had 2, 3, 4% drawdowns. So it really kind of can derail your plans if you are saving for these near-term cash needs. But yes, if you do have a 2-year kind of cash need, then maybe it can be suitable. But again, you need to understand that there is risk involved and there will be ups and downs, which, again, most of the investors that I talk to, when they look at savings alternative and consider these cash management, they really believe that it will give them a steady kind of increase. And they do get a shock if they see a negative return in their portfolio, right? So be very careful. Don't go with just the superficial top end, projected yields that are put in, but go a level deeper in terms of understanding the risks and also what your own situation is, right? Because that should determine whether those are, those satisfy your need or not. All right, if we go on to the next slide. So this basically talks about actual solutions that are available in the market. So I think Syfe Cash Plus is not the top in terms of the projected yield, but we're somewhere in the middle. But also it means that we are very prudent in terms of our composition to give you that very steady kind of return profile, versus if you go on to the next slide, it will tell you, solutions which have a much higher kind of projected yield, there have been drawdowns, right? So the blue line is the Cash Plus, Syfe Cash Plus, which is a 2.3% projected return, which is pretty much a straight line, right? So this is what you actually want from a cash management solution, and especially for near-term cash management solutions. Versus there are some other, options available which project a much higher yield, but then, you have these drawdowns of 2 to 4%, right? You see the orange line, you see the blue line, and this is what a lot of investors, do not know about, or they have not been educated about it, and they go into these solutions looking at the, headline yields, and only to be shocked, a few months later.
So it's also similar to what we've gotten in the Q&A. And it's, banks are offering really attractive interest rates, right? So how does Cash Plus stack up, and what's a way, like a framework to also think about it?
Yeah, I think we have a slide on it, I think. Look, yes, banks have increased their interest rates over the course of this year, quite prominently, with some claiming as much as 5% that you can generate on your savings bank account. But the reality is you need to hit, at least 10 different criteria to get these 3, 4, 5%. You need to have insurance, you need to have a housing loan, you need to have, salary credit, you need to, do credit card spends. There are, all these different ifs and buts for you to really get to those numbers. And I can tell you, the actual realistic interest rates that you get through these platforms is more like what we have on the, first column. Because even to get this 1% or 1.5%, you will need to actually satisfy a 10K balance, 2K salary credit, some credit card spend, all of these, right? So even after satisfying all of this, you're getting that 1.5%, versus if you really want to hit these numbers of 5%, it's next to impossible. And by the way, there is also capping, right? This interest rate is only applicable to the first $25,000 or the first, $40,000. There are all these ifs and buts that are embedded within the interest rates that are being put in. So again, it goes back to that question of like, don't just go with the headline yields, because the reality is actually much more different. Versus in the cash plus solution, it is very transparent in terms of what we are giving to you. There is absolute like flexibility. Your money is not locked in, and as interest rates increase, you're not sort of left behind. You will also participate as the interest rates move. The bonds will get reinvested into higher yielding subsequent bond issuances, and then that will make sure that you also participate in the rising interest rate environment.
Okay, I think this is also something that we get a lot, right? Which is would the projected yield be revised upwards again, as potentially like because some of the hikes that have already happened are not really reflected yet, and also we could potentially still see more for the remaining 2 FOMC meetings.
Yeah, so look, I think we have this chart which kind of tells that how we have been very prudent in terms of raising our projected returns for our cash plus portfolio, and how the actual net realized returns of the solution has been. So if you look at the period between 1st of Jan to 19th of Jan, we projected 1.2%. The actual realized was 1.32%. Then we did a hike from 1.2 to 1.5%. So this was in tandem with the first kind of rate hike that the Fed did. And for the period of this relevant projected return, we actually realized 1.5%. The second rate hike subsequently happened, and then we increased our rates to 1.9% in August. And again, we were able to give an actual net realized return of 1.92% as well. And more recently, the 75 basis point hike in September. So we subsequently raised our projected returns in reaction to that. And we will continue to kind of update you how the actual returns of the portfolio is as we move forward. Now, going forward, there is 2 more rate hikes coming. So one is early November, and then potentially another one in December before we close off the year. So yes, I mean, in terms of do we anticipate the rates to continue moving up? I think so. And as and when these rate hikes happen, you will see, our projected returns being updated as well.
Yeah, so we're depending on Nick and his team to give us the updated projected yields, and then we will of course share that when we have that. Okay. All right, so this is also something that we've gotten a few questions on, and that's how should investors consider cash plus versus other sort of like safe haven, cash-like assets like SSB, fixed deposits, or T-bills. Okay, so we have a table that I think Ritesh will explain further.
Do you want to cover this, Grace? I think will be great for you to cover this.
Yeah, sure. So I think for SSB, it's been very attractive, right? I think if you go in and you're trying to, I think the latest tranche, it's even higher now. And you can also have an additional funding source, which is SRS. But for us, I think for SSB, the issue here, like from a usability, like for someone like myself, is that even if you try to get an allotment of let's say you want to put 30,000 or 50,000, right? It's not guaranteed that you would actually get that. I think the last time I tried, it was I only got about 40% of what I initially wanted. And then, so in terms of minimum, it's not really that there's a minimum, but there is kind of like a maximum, right? If you do have more to deploy, you don't really, there's no guarantee of whether, that would be met. And also, I think in terms of redemption, it is a bit more involved, slightly, and it's you don't really have the ability to do it, on the next day or the same day, depending on how much you put in as compared to Syfe Cash flow. So I think the main point is liquidity and flexibility. All right, so going on, and I think it's also, fixed deposits. So fixed deposits, generally, the shortest is 6 months, and the longest is 24 months, and there are minimums. There are like withdrawal penalties. So this one, we did it in the middle of, towards the end of September. So the average yield back then, taking from a Seedly post, it's roughly in line, right? But then you do have a bit of lock-in, and for some of these, you have the minimum as well. So again, it comes down to liquidity and flexibility. I'm just going to see if there were any more questions that are related to this. Okay, I think that's about it. So yeah, I think now we just sort of go over all the questions that we got. So I'll just go down the list. Okay, so this is already answered. All right. With the rising interest rates, right, should one still think of like parking money in a product like Cash Plus or REIT Plus? So I think for the first one, right, for Cash Plus, it's yes, if that's something that you're still keen to do to the, you know, for additional cash, and you don't want to be locked up, and yeah, obviously it still makes sense. As for REITs, you know, we do see that for the, you know, because a lot of the REITs are quite capital intensive, and they have so far, you know, there are things that they can do to manage the interest rate risk and the borrowing costs, but they then, you know, of course, they take on a bit more risk. So you do see, you know, more volatility as well. So I think depending on your own investment appetite and like risk capacity, I think it's, yeah, you can also try to make the assessment for yourself. But of course, you know, we are available for conversation with the advisory team, and more than happy for you to reach out. Okay, so next one is gold a good hedge against inflation? Ritesh, do you want to go or?
Yeah, so look, I think gold has been an asset class which, if you think from a correlation standpoint, it is uncorrelated to, you know, typical asset classes such as equities and bonds, and it does play a role in terms of the asset allocation of a portfolio. So that's why you will see gold as, you know, a component of our core portfolios across, you know, all the risk managed ones. So you will see a gold component in those. Now, whether it is a good hedge against inflation, you know, there is debate around it, right? Like, you know, if you look at this year, for example, gold initially went up, but I mean, like over the course of the last few months, it's been struggling a lot. So it is hard to say whether it is a hedge against inflation, but as a portfolio diversifier in a long-term oriented solution, it does have, you know, those correlation benefits and helps in terms of reducing your drawdown. So that's how we think about gold. We typically have around 5 to 10% allocation to it. And in the context of, you know, diversification, I think that is a decent kind of an allocation for you to have towards this asset class.
Yeah, maybe I can just jump in and add a little bit to that. I have a friend who buys gold bars, and he does believe in the value of having a nice shiny metal lining his cupboards. He was a very, very happy person when in March, when there was a peak uncertainty. And he was expecting this spike in inflation to continue to make him a happy and happier person. Last I caught up to him, he says gold is a 4-letter word, so don't talk to me about it. But the reality is, from a portfolio management perspective, the correlation studies that have been done between gold and inflation have generally been mixed. In other words, specific to the question that was asked, whether or not gold is an effective hedge, right? Not necessarily a diversifier, but the word used was hedge against inflation. The data, the evidence is kind of mixed. Now, is gold a good hedge against uncertainty when unforeseen events happen? That is a little bit more, clearer. So you saw gold price rally up to I think it was north of $2,000, and that was during the Ukraine invasion. So in times of uncertainty, people do flock to the yellow metal. But as for inflation, the numbers don't seem to suggest that it is a fantastic hedge per se. It does have an uncorrelated behavior, like Ritesh said, but it's not a great hedge by any measure.
Yeah, if I could also add, so the thing is, gold is sort of compared against the US dollar, which is, you know, similarly seen as sort of like a risk or risk reducing asset. And the reason why we've seen the US dollar really, really rally, and that has affected gold, right? So because people are flocking towards like US dollar, which is liquid and it's done very well. It moves with interest rates, right? So as interest rates are going up, then the dollar becomes stronger. So in that sense, yeah, I mean, if you think of the reason, right, of why interest rates are going higher, and that because of higher inflation, then that's also why the dollar has been so strong. So that hasn't been great for gold in this type of inflationary environment. Yeah, but for diversify, yeah, for definitely, I think it adds value in a portfolio. All right, so next one, so we've answered, okay, if the Fed funds rate tops 4%, will Cash Plus yields also be close to 4%?
Maybe I think like Nick, if you could take a first stab, but I mean, what I can say is it might not be 1-to-1 because there is the US Fed funds rate, and then we are investing into Singapore dollar denominated underliers, right? So there is a nuance there. It will track, it will be in tandem, but it might not track one-on-one.
Yeah, you're absolutely right to say that it will not track because these are two fundamentally very different numbers. So the Fed funds rate is determined by committee taking into account data, right? But what the market, by the time the market prices it in and translates it into bond yields that LGI as a fund manager can then invest into, there is a transmission process. And in the course of that, a whole lot of other things get taken into consideration, like what is the idiosyncratic, what is the issuer specific risks, or what are certain features that are built into these bonds. And then there's an issue of timing. Now, I think there was an earlier question. Do people expect that bond Fed funds rates will peak past 4%? Well, I have a mortgage, and for my own self-interest, good Lord, I hope not. What would be better would be if the Fed funds rate is more gradually allowed to hike up slowly in response to inflationary data. In other words, not too fast. The trouble and the concern that we kind of have, and I think market is starting to price that in as well, is that if the Fed is too aggressive in its Fed rate hikes, then there is a chance that it could worsen any potential recession more than they intended. So as much as the talk is tough, I think necessarily the Fed needs to sound tough on inflation going into November elections after all. But there is a risk that too hard, too fast is likely to increase the odds of a harder landing. So a nice gradual path up, that would be preferable. A sharp spike up, that's not going to be good news, whether you are a corporation looking to borrow money, whether you're an individual that has to finance your housing loan, or even if you're looking to take a car loan out, because all of these things take reference from the Fed hike. And I can't speak for the rest of the folks in the audience, but my salary is certainly not keeping up with the Fed funds rate moving up. So for better or worse, we're hoping to see that the Fed's funds rate do not get too aggressive, regardless of what happens to the bond market, because by the time it happens to the bonds, a lot of other factors will then have to be taken into consideration.
All right, so the next question is, what is the amount insured for Cash Plus? And given that they are, Tash, could you explain sort of like how that works, like where the funds sit, like that we sit the custodian account, and if you could explain that to the audience.
Sure. So this is amount insured for Cash Plus. All right. So look, in terms of the Cash Plus as a solution, but not just Cash Plus as a solution, but as a platform, one of the key aspects that we want to ensure is safety. And to that extent, what happens is, in terms of our license, we are a CMS license holder, right? And we, by right, as part of this license, we are required to keep all client assets completely separate from our own assets. And as part of that, what it means for the end investor is your money is kept safe. We are not allowed to use your money for our purposes. Our own corporate account, corporate like balance sheet, everything sits completely separate. Plus there are, base capital requirements that the MAS has put us on. So ultimately for the end investor, what it means is even if, God forbid, something happens to Syfe, our corporate entity will be impacted. But because client assets are kept completely separate, those monies are for you to redeem, right? So from that perspective, the money is safe. It is not a savings product though. So what that means is there is no like insurance attached to it in the traditional, sense of a savings bank account. But in terms of safety, it has got all those bells and whistles because it kind of operates under the regulatory framework of the Singapore MAS.
Thank you. Okay, so one more, and we're almost at time. It's that why does Syfe not charge any fee?
Great question. So look, again, the intent is for us to make it easier for people to access our platform in a holistic manner. And what we realized was a lot of money is actually sitting at the bank. And while people want to invest, they just don't know how to get started. And they just need to be guided. They have some base sort of frictions when it comes to trusting a platform and starting their investment process altogether. So the Cash Plus portfolio really for us is a way for getting people to be comfortable with our platform. And then subsequently, what we observe is people do invest into other investment portfolios where we do make a small amount of fee. So this is more of a delight feature in my opinion, where we want to impress upon clients that client experience and giving you the best kind of solutions is the intent with which we have launched this product, and then make it super simple, super friction free for you to actually solve for your long-term needs. Because even if you invest in Cash Plus, if you look at where inflation is, you will still be a net loser in a long-term perspective. So the real challenge for us is to make people understand the value of investing, and that education process can come in much more properly once you are on the platform, and we can tell you how to then optimize your cash to cater to those long-term goals as well.
Okay, so I think we have one last question, and that's, can stocks be a hedge against rising inflation?
Great question. Again, I think parts of the stock market, there are certain sectors that tend to do better during inflationary periods. So there are those components that you could look at. But again, it's an active kind of a call that you are making. So for example, if this year you invested into more energy oriented stocks, then first half of the year you would have made a good amount of money. Commodities did pretty well. Apart from these two, there are hardly any other asset classes that had positive returns this year, right? So from that perspective, yes, I mean, these could be called, in a way, hedge against inflation or fight against inflation or protect against like these inflationary pressures. But that does not mean like not every inflation hedge always works. It is more like an insurance policy, and sometimes it works, sometimes it doesn't. So for example, if you look at this year, typically as inflation goes up, interest rates go up, financial institutions should be able to increase their net interest margin. So they should benefit, but that's not really happened this year. So there are some of these stock sectors which are supposed to be inflation hedge, but might not have turned out that way. At the same time, inflation hedge doesn't mean you will have positive returns from them. You might have lesser negative return. So that's also something for you to understand. If you want to have a proper hedge, that needs to be incorporated in much different manners, typically using derivatives and other instruments, which has its own costs involved too.
Yeah, if I could add, I think the thing is, so I know this year has been very tough, and for both bonds and equities. But if you look over the long term, right? So just hearing about this thing called a Dalbar study. So it looks like just I know we've seen like all the index returns, right? But this actually looks at like what investors get, right? So for example, in the last 30 years, if you went into like an equity portfolio, right, and then for equities, like that gain about very high single digits, almost 10%. But if you look at like investor behaviors, like what returns do investors actually end up getting, and it's half of that. And a lot of it comes down to like investor behavior, right? Because I think in times where where the markets start to go down, and then people pull their assets out, and they don't sort of enter back in again, right? And then that's when you're timing the market. So I think from that timing, investors do tend to not be able to participate in like the rebound as well, even if you're missing a bit on it's coming down, right? And then if you think of like why would like companies sort of end up being a better hedge against inflation over the long term, that's simply because they are much better than individuals to put capital to work and turn that into profits, right? So I know this, so far it's been tough. If you look at just historical returns of, equities, could be US or global, right? You are still getting, 6 to 7 or 6 to 10%, depending on which sector you're looking at over the long term. And that is actually, if you think of beating inflation over a longer time period, right, it is to be invested. All right, so we have one last question, which is like, which sectors may perform well during inflation? So we should have an inflation webinar that we did back in February. So I think a lot of that is still relevant. And if you'd like, please go to our YouTube channel, and to find that. So any parting words for the audience who've stayed with us till the end?
Of course. So I think for me, it pays to kind of stay invested, particularly in this period where volatility is high. It is imperative for people to realize, like, what your safe haven assets are, but also from an opportunity standpoint, if you're afraid, maybe you don't want to put a lump sum, but these are great times where you can keep deploying your money in a more systematic basis into the markets. Because while, yes, there are drawdown periods and, the market is down 20-30% this year, these are great opportunities, because typically what happens is whenever there is a bear market, it is usually followed by, positive returns in the coming 1 year, 3 year, 5 year basis. So my only suggestion would be to, number one, like, think through what your safe haven assets are. How do you want to manage your cash in an effective manner without having any volatility? And peace of mind is key when it comes to cash. And once you have that peace of mind, then you can deploy it in much more systematic manners.
Yeah, I just want to point out that 2022 has been truly an exceptional year. And more so because in the past 10 years, we've not seen a drawdown quite as severe as what we are seeing now. I do recall in 2008, the drawdown was a particularly nasty one, at least in Asian equities and global equities as well. Asian equities dropped in 2008 about 67 or close to 70% in some cases. Since the peak to the trough, we are now approximately 35% down. But that doesn't necessarily mean that with a down, you can't see a sharp upswing. So for that reason, it's worth keeping some money in liquid assets. Don't lock it up for too long. Fully acknowledge that the fixed D rates are very, very attractive, and you have a lot of attractive carrots being dangled in front of you, whether it's plush toys, a sack of rice, or maybe a couple of NTUC bonus points or whatever it is. But the question that clients and investors need to ask themselves is, what is this cash supposed to do for your portfolio? If you're looking for cash to generate a return and move your portfolio return from 3% to 30%, it's not going to happen with cash. I can promise you that. But if you're looking for cash to hold on and then look for opportunities to deploy, and there are a lot of attractive opportunities given the current valuations, then this cash needs to be liquid. You need to know that there is a counterparty that will take the units and then give you proceeds for that. And you need to be able to move fairly quickly into the market when you do see prices at the level that makes them attractive to each investor. So for that reason, a solution like Syfe Cash Plus does meet that tradability criteria. It does meet that liquidity criteria, and all that because the underlying two funds also have a correspondingly very quick settlement time. But do that as it may, valuations are looking at approximately one standard deviation below historical average, right? So be nimble with the cash. Don't hold too much of it, and wishing everybody the best in navigating this high interest rate environment.
Yeah, thank you, Nick. Okay, we have one. So we wanted to share a promo code in case for people who are topping up or people who are new. So in terms of fee waiver to top up for Cash Plus, there's notice because Cash Plus there's no management fee, right? So it's 0 fee. Yeah, but if you wanted to think about adding to your investments, then if you're existing or new client, please use these promo codes. All right, I think that's all the questions we have. And okay, sorry, there's one more, and it's about T-bills, right? Because so for T-bills specifically, there aren't any issues with low allocation amounts. The risk is not knowing the yield it's not getting, and that can be mitigated by putting in a competitive bid. So how does Cash Plus stack up against this? So again, it's because it's a projection, right? Both on where T-bills will be and where Cash Plus will be. As we see in the next 6 months, for example. So I'm afraid we aren't really able to provide that kind of protection. But again, it's something that we will be monitoring and tracking.
Yeah, I mean, with regard to SGS bonds and SGS MES bills, and even T-bills, if you're trading that, the one thing that, well, fact of the matter is everybody's looking at SGS bonds because it does look quite attractive. And I have friends who talk to me about it. The question that I pose to them is that, do you need to be able to redeem these bills at any point in time? In other words, do you want to break this bond to create generate cash? If the answer is yes, then the liquidity in the secondary market for T-bills can be a bit challenging. It's not guaranteed that you're going to find someone else on the other side of the trade that will give you cash for your bills, right? Whereas for something like a unit trust, you know that the fund manager is bound by regulations to meet good on any redemptions that investors would need to make. So setting aside the question of liquidity, the other thing is the question of tradability. So for each individual to investor to consider the framework, not just getting the yield is not just one thing, it's the liquidity of it as well as the tradability of the instrument. So for each person to consider.
Yeah, thank you, Nick, and thank you, Ritesh, and thank you everyone for joining us. Yeah, if you do have any more questions, please reach out to our advisory team, and we'll be more than happy to help.
All right, thank you, Grace. Thank you, Ritesh, and thank you, everyone.